2011 or 2013, when the word Bitcoin meant little more than internet money or, worse, some fringe libertarian experiment. But retail investors, they were already there. Reddit threads, Discord servers, forums. Average people, not fund managers, were downloading wallets, running nodes, and sending coins across the globe for fractions of a penny. And institutional investors? Nowhere to be found. This is rare in finance. Normally, institutions lead the way. They have the analysts, the capital, the tools. Retail follows. But Bitcoin flipped that script. For the first time, the crowd got in before the suits. And that was important. Because for most of the past decade, Bitcoin was too volatile for institutional money. Too unpredictable. One tweet, one regulatory hint, and it could crash 30% in a week. And honestly, I felt that way too. I've always thought Bitcoin was an amazing innovation. But let's be real, it's double or even triple the volatility of the NASDAQ, and the NASDAQ is already volatile. So why would anyone sane, managing serious capital, choose to deal with more volatility? That was the reasonable question, especially when you're managing pensions, endowments, or client portfolios where stability is as valuable as returns. But something changed recently, and here's where it gets interesting. We had a real-world stress test, a geopolitical shock, new tariffs, macro uncertainty, global market jitters. The NASDAQ fell, and this time, Bitcoin fell roughly the same amount, not double, not triple, the same. That's not just trivia, that's a signal. Bitcoin's volatility, the thing that kept serious money on the sidelines, is coming down. And that could mean we're entering a new phase in Bitcoin's evolution, from speculative asset to a maturing part of the broader market. Volatility is often misunderstood. People think it just means up and down, but it's more than that. It's a measure of uncertainty, of disagreement about what something is worth. Early Bitcoin was incredibly volatile because no one knew what it should be worth. Was it digital gold? Was it a payment network? Was it worthless? But over time, a consensus started to form. Use cases narrowed, narratives matured, and now we have things like ETFs, custody solutions, regulation. Whether you love or hate it, it's structure, and structure brings stability. Also, the profile of the average Bitcoin holder has changed. It's no longer just a guy with a hoodie mining in his garage. It's BlackRock, it's Fidelity, it's sovereign wealth funds. These entities aren't trying to 10x in a week. They're looking for long-term exposure, risk-managed portfolios. And that kind of investor behavior reduces sharp swings. Bitcoin is still volatile. It's not a utility stock. But the question is not whether it's volatile. The question is whether it's becoming less volatile relative to the rest of the market. And recently, the answer has been yes. This shift has major implications. First, it broadens who can own Bitcoin. Institutional money has strict risk parameters. If Bitcoin's volatility drops below a certain threshold, it can be included in models, portfolios, even retirement funds. Second, it changes the narrative. Bitcoin isn't just a moonshot or hedge against fiat anymore. It becomes part of the conversation about long-term asset allocation. That's a different kind of legitimacy. And third, and this is subtle but powerful, it means Bitcoin is being priced into the global financial system. It's less of an outlier and more of a component. A strange new component, yes, but one that plays by some of the same rules. This doesn't mean Bitcoin becomes boring, but it does mean it may stop being uninvestable. And that's a big deal, because if we really zoom out, the long-term value of Bitcoin may depend less on how revolutionary it is, and more on how integrated it becomes. And ironically, the very thing that used to scare investors away, its wild, unpredictable swings, might be the thing that slowly disappears as it becomes part of the mainstream.
I think this is interesting. The retail investors, they were much faster at getting involved with Bitcoin than the institutional ones. And I always thought Bitcoin's amazing, but it's double or triple the volatility of the NASDAQ. NASDAQ's already pretty volatile. Why do I need to deal with this added volatility? Recently, Bitcoin, when it went down during the tariff, only went down as much as NASDAQ. So it seems the volatility as an asset class is coming down.
Global equities, stocks around the world, are worth about $120 trillion. That's companies, growth, productivity, and capital all priced in. Gold. Combine what's above ground and what's still in the earth, and you're looking at somewhere around $20 trillion. Bitcoin? Roughly $2 trillion. At first glance, that might feel like a lot, but when you compare it to global wealth, estimated around $450 to $500 trillion, Bitcoin is still a rounding error. It's about 0.5% of total global net worth. So when someone asks, can Bitcoin double? The answer shouldn't be based on hype or headlines. It should start with scale. And at $2 trillion doubling to $4 trillion would only bring it to 1% of global wealth. That's not wild, that's plausible. In fact, for an asset with increasing institutional adoption, public awareness, and technological resilience, well, that might even be conservative. Some people go even further. They throw out numbers like $50 trillion, $100 trillion, treating Bitcoin like it'll swallow the entire financial system. I think we need to be grounded. Bitcoin is not going to replace everything, but the idea that it could grow from 0.5% to 1% or 2% of global wealth over the next decade, that's not aggressive, that's reasonable if it continues to find a role as a store of value, a hedge, or a neutral reserve asset. And this brings us to a bigger backdrop, the slow but unmistakable trend of de-dollarization. For decades, the US dollar has been the backbone of the global financial system. Trade, debt, reserves, all dollar-dominated. But things are changing, not all at once and not with drama, but gradually. More countries are settling trade in their local currencies. Central banks are reducing their dollar reserves. Alliances are shifting. US exceptionalism. This idea that the US can borrow indefinitely, print with impunity, and dictate terms is starting to be questioned. Now, this doesn't mean the dollar collapses tomorrow, but it does mean the world is looking for alternatives, not replacements alternatives. And here's where Bitcoin enters the conversation. It's not tied to any country. It has no central bank. It's borderless, programmable, auditable. It's not perfect, but in a multipolar world where trust in any one system is fading, a neutral system starts to make more sense. This is how to think about Bitcoin's potential growth, not as a moonshot, not as a gamble, but as a reflection of where the world might be going. A world that's more decentralized, less dollar-dominated, more fragmented, but also more interconnected in new ways. Bitcoin may not become the world's reserve currency, but it doesn't have to. It just has to be part of the basket. Part of the conversation, and that alone could take it from 0.5% to 1%, maybe even 2% of global wealth.
True. Equities are, let's say, 120. Gold, above and under the ground, is 20. And then Bitcoin is 2 trillion. And I was like, okay, well, 2 trillion, let's say it represents 0.5% of the net worth of the world. Could it go to 1 or 2? Some people say, oh, Bitcoin's going to be 100 trillion. I'm like, okay, that's not, maybe a bit of an aggressive estimate, but could it double over a period of time? And then we talked about the de-dollarization of the world, the end of US exceptionalism. So those would be some of the reasons.
Bitcoin may not become the world's reserve currency, but it doesn't have to. It just has to be part of the basket, part of the conversation. And that alone could take it from 0.5% to 1%, maybe even 2% of global wealth. The people who once dismissed Bitcoin, who called it a scam, a bubble, a toy, are slowly waking up. And the most powerful realization isn't that they were wrong about Bitcoin's price. It's that they were wrong about Bitcoin's purpose. This isn't just a trade, it's a tectonic shift. And it's happening at the exact moment when the US can least afford to miss it. Let's be honest, American exceptionalism is fading. We're no longer leading in manufacturing. We're not at the forefront of AI hardware. Our education, infrastructure, and even political cohesion are under stress. And now, even the dollar, the core of our global influence, is being questioned. Countries are moving off the dollar, settling trade in yuan, exploring gold-backed settlement systems. The post-World War II order is wobbling. But amid all of this, there's one asset class where the US still has a chance to lead: Bitcoin and digital assets. Not just financially, but ideologically, technologically, and politically. And for once, it seems like people in power are starting to see that. The Bitcoin Policy Institute, an actual policy group working with lawmakers, is proof that the conversation in Washington is changing. Quietly but steadily, voices in the US government are moving from skepticism to strategy. They're not just talking about Bitcoin, they're thinking about how it fits into national security, energy policy, and the preservation of free markets. Why? Because Bitcoin isn't just code on a blockchain, it's infrastructure.
Those are top of mind for everybody, working on digital assets in the White House. There will be the forthcoming report on the interagency activities. We've already taken some steps with the SPR. How do we follow that up with the accumulation plan? So there's no shortage of opportunities and things to do. So after we leave here, I'll get right back to it.
It's a digital monetary network that can't be shut down, can't be censored, and doesn't answer to any one country. That's a powerful thing, especially in a world growing more fragmented and authoritarian. And here's the irony. Bitcoin may be global, but its heart, its innovation, its development, its capital is still largely American. The wallets, the miners, the ETFs, the developers, the businesses, they're here. We're ahead, but we're at risk of losing that lead. If the US wakes up too late, other countries will seize the mantle. They'll regulate more wisely, attract the capital, host the infrastructure, write the standards. We'll be forced to follow. But if we move now, if we treat Bitcoin as a strategic asset, like we did with oil in the 20th century or the internet in the 1990s, we don't just protect American values in a digital future, we lead it. That's what's really behind the $100 trillion comment. It's not just about market cap. It's about what happens when the world realizes that Bitcoin isn't just a speculative asset. It's neutral money for a multipolar world, and the country that builds around it, not fights it, will shape the next century. That can still be the United States, but only if we decide it's worth leading again.